Hi everyone! Optimism is waning on Wall Street. The rally that started in early November could end this week with a sell-off. Last week, stock markets closed without a clear dynamic. Although the uptrend remained intact, it was rather difficult for bulls to push stocks higher. The euphoria followed the release of encouraging inflation figures is gradually fading away. Investors realize that the Fed will keep raising rates, albeit at a slower pace. The rhetoric of the regulator is far more hawkish compared to other major central banks. As a result, traders' expectations of a slowdown in aggressive tightening were in vain. Fed policymakers stated that at least two positive inflation reports are needed to make sure inflation has peaked. This is why speculators are looking forward to CPI data for November and December. The Fed remains committed to capping inflation, which means further tightening. Several Fed members confirmed it last week. The watchdog has said more than once that it is ready for a contraction in economic expansion and even the risk of a recession. The housing market is cooling. There are plenty of other economic reports signaling worrisome signs. Last week, a batch of important macro stats was unveiled. This week, the economic calendar is also quite eventful. The most anticipated event is the publication of the Fed meeting minutes. This trading week will be shorter on the occasion of Thanksgiving Day. Watch our video review till the end and leave your feedback down below. Let's start. So the Fed meeting minutes will be in the spotlight. It means that traders are likely to remain cautious ahead of their release. A drop in trading volumes may also occur due to Thanksgiving. However, investors will hardly find something new in the minutes. The last Fed meeting took place before the release of upbeat inflation data, and the rhetoric of policymakers was rather hawkish. Despite the fact that several members made quite dovish remarks, they were overshadowed by hawkish ones. The results of the Fed meeting turned out to be neutral. Market players are now trying to foresee further steps of the regulator. This is why they are likely to pay more attention to new comments of Fed policymakers rather than minutes. Besides, several members are scheduled to make speeches this week. Investors are sure to take notice of them. On Monday, San Francisco Fed President Mary Daly warned that adjusting too much could lead to an unnecessary painful downturn. She also noted that the key rate is currently in moderately restrictive territory and there is more work to do to get the monetary policy in the right place to cool inflation. Cleveland Fed President Loretta Mester said that it is necessary to witness a steady decline in inflation before taking a pause. The University of Michigan Consumer Sentiment Index, durable goods orders, and new home sales are among other crucial reports which are on top this week. Traders are also anticipating PMI indices for November from the US and other major countries. The earnings season is still in full swing. The quarterly results and forecasts of some media giants turned out to be mixed. For instance, Disney shares dived down by 40% this year. On Monday, they were up by 7.5%. The company announced that Bob Iger is returning to Walt Disney as a chief executive. The legendary CEO who turned Disney into the world's most powerful entertainment company is expected to boost investor confidence and profits. However, on Sunday, traders were shocked by the news that Bob Chapek stepped down as CEO. Iger agreed to serve as CEO for 2 years, which caused a contradictory market reaction. Disney is going through hard times. Speculators expressed concerns about whether the 2-year term would be enough to make the necessary changes and find a worthy successor. Disney shares soared following Bob Iger's appointment, signaling investor confidence in Iger, who has been at the helm of this company for 15 years. And now let's move on to the stock indices. All three benchmark indices closed on Friday with gains. They rose by approximately 0.6%. The Dow Jones climbed the most, whereas the NASDAQ showed the weakest performance. However, it did not affect the weekly results as three stock indices ended the week in the red zone. The Dow sank at the least, declining by 0.01%. Some analysts reckon that it was a kind of signal for the end of the rally that took place in the bear market. Stock indicators began to move away from a long-term downtrend line, so traders should be alert. The risk of a new wave of sell-off may increase in the near future. Trading on Monday was rather lackluster. Stock indices failed to maintain a further rise. The Dow Jones declined by more than 100 at the opening, while other indices incurred bigger losses. Risk appetite was also affected by negative news from China. The government is likely to impose new restrictions. Over the weekend, China recorded its first COVID death since May. Stock indices seem to have slid down in the sideways channel. This is why analysts are betting on the new resumption of the downtrend. The S&P 500 tumbled by 0.7% last week. The index kicked off the new week on a negative note, failing to reach a pivot level. An unsuccessful attempt to consolidate above the resistance level of 4,010 is a clear sign of a downward movement. A breakout of 3,910 looks quite feasible. After a modest increase, the S&P 500 index is likely to head to this level once again. If so, the next target level will be 3,800. The latest inflation data rekindled hopes for a less hawkish stance. Whatever the economic report is released and speeches made, investors continue to look for hints at a possible slowdown in tightening. So the minutes will hardly be an expectation. It appears speculators do not lose hope that the Fed will eventually end the tightening cycle. Nevertheless, they should have already learned from their mistakes how dangerous it is to rely on expectations. The situation could become clearer towards the end of the year as more macro stats will be released. It will help market players make more accurate predictions. The earnings season is coming to an end. More than 90% of companies, including in the S&P index, have already unveiled their revenue results. Many earnings reports topped Wall Street's forecasts. However, lower aggregate profits were recorded. In addition, forecasts for the following quarter were downgraded. The oil and gas companies showed the best results, which hardly came as a surprise. The compound annual growth rates for all companies would have been negative if not for these companies. As for the NASDAQ 100, its trajectory differs significantly from the other two indices. Last week it dipped by almost 1.6%. It logged the worst performance on Monday, dropping by 1%. Such a drastic fall was probably due to a decrease in Tesla, Amazon, and Apple shares. The movements of all three stock indices will depend on further incoming news, especially the economic reports. A large batch of reports will be released on Wednesday. This day will be the busiest one in the week. The Fed minutes will also be revealed on the same day. On Thursday, trading floors will be closed. On Friday, trading volumes are likely to be low, as trading will end earlier. That is all for now. Subscribe to our channel and keep close tabs on the latest market developments. See you!